Welcome back, guys. It is late February and you all know what that means. It's time to give half of your money to the military. Time to think like an investor. So just as I'm always disappointed every year when half of our income goes to military spending, I'm also equally disappointed that I'm doing everything I need to be doing on YouTube. I'm putting out searchable videos, people in the comments saying, I really love this video, I'm getting a ton of value, and yet 80% of you guys aren't even subscribing to the channel. Like, what's that about? I'm doing my part here. I'd really prefer if you did your part too. Just hit that subscribe button down below. Just show your support for the channel. I would appreciate that so much. We're gonna talk about this wonderful concept of paying taxes. Taxes, you can't live with them, but we can't really live without paying our taxes because if our apartment's on fire and we need to be rescued, well, who's gonna rescue us? And if we need to kind of build a road to somewhere, where is that gonna come from? These come from our tax dollars. So, I mean, thankfully we do have them to some extent because they provide a lot of great things. But one funny fact about federal tax dollars actually that always blows my mind, 8 to 10% of every dollar you pay in taxes, and every person who pays taxes in your country, 8 to 10% of that money goes to debt. And what that means is it's just interest that the government has to pay from taking out debt on things they bought before but couldn't afford. So a little happy note for you there today on this beautiful day is that all that money you're paying to the government, it's actually going to banks. It's going to interest. I mean, not all of it, but a substantial portion of it. But that is not what today's about. What today's about is talking about taxes and how our investments are impacted, or how taxes impact our investing, right? Because throughout this year, we've seen an explosion in the popularity of investing. It was like 10 million new Robinhood brokerage accounts were open last year. And all these people, a substantial portion of them are probably investing for the first time, right? And you have all these people who, for the first time ever, maybe you're in the same situation, you're gonna have to claim tax returns and different slips, and you're gonna have to get all your ducks in a row for how much money you made in the stock market or trading or whatever it might have been. So today I wanna break down for us what are the implications for our taxes when it comes to our investments. And the older and more sophisticated you get, the more and more important this becomes. And the way I like to think about this is like, think of a Formula One car. And I'm not sure if you're a Formula One fan, but you can understand this analogy. It's like a Formula One car is the fastest thing that we like jam a human into and then make them race with. And they have to be extremely fast because the people who win these tournaments make all sorts of money and there's all sorts of things on the line. But when it comes to engineering a Formula One car, yes, the engine's gonna propel that car and it's pretty light, it's gonna go pretty fast, but the main focus is reducing drag, right? At a certain point, it's like you can only make it so much more powerful within the rules. You need to start shaving weight and making sure your driver is losing pounds and making sure that every piece of material in the car is as light as possible. And the older you get, the more your investments get like that, because it isn't so much about hitting home runs or trying to make a ton of money. It becomes about how do we reduce the drags on our portfolio? And there's a lot of different drags that can happen in your investments, but taxation is by far and away one of the biggest inhibitors of your investment performance or your wealth over time. Now here's a crazy example, okay? Let's say you're 25 years old. This might be a little crazy of an example, but just bear with me. You've got 50,000 bucks to invest and you're going to invest $500 every single month. And maybe if we're, lucky and we invest aggressively, we can get an 8% rate of return until retirement from like 25 to 65. That's 40 years. In that case, we end up with about $2.6 million. Okay, that's crazy. Think about that. You put away 50 grand, you put away 500 bucks a month, and you end up almost worth $3 million, 2.6. But if 25% of our gains get taxed each year, which in many cases they do, if 25% of our gains get taxed each year, that means we only really effectively make a 6% rate of return instead of before where we made 8 when it was tax-free. If we get taxed, we only make 6. That's just an example, right? You, in that case, at 65 would end up with 1.4 million, okay? Now, that's still a lot of money, but you can see the difference there. $1.2 million of your hard-earned money and your investments just disappeared into thin air to pay for all of the government's fancy private jet trips to St. Bart's. So now, assuming you know how the tax system works, and by tax system, I mean this whole idea that we earn income and we have marginal tax brackets and we have different levels of tax brackets, and the larger our income is, the higher the tax bracket goes, and then we can deduct things and we can have tax credits. Assuming we understand all that stuff, it's really not that complicated. if you go and research it for a little tiny bit. We can pretty easily understand how investing taxation works too, because there are really just 3 types of investing tax, but it's gonna add some nuance to the things that we typically know. So what I'm going to do to make this as simple as possible is I'm not going to arrange them from most effective to least effective. I'm going to arrange these different things from most simple to most complicated. So we'll start out really simply. The number one most simple form of investment tax to understand is when you earn interest or income, okay? Interest and income is the kind of income you earn on a rental property. That's income, okay? And we'll quickly understand what this means. If I put money into also, let's say, a bond that pays a fixed rate of interest, like 5%, interest is the same as income, right? If I somehow have some form of GIC or some guaranteed investment, the interest on that is income. So there are many different types of investment returns that come in the form of income. And as we explain the other 3, it'll start to make a lot more sense. But investment income is taxed fully at your marginal tax rate. So let's say you make $100,000 per year, or whatever it might be, and you make $10,000 in interest from a rental property and from a collection of a bond portfolio or some GIC. What that means is 100% of the money you made is getting added to your taxable income. So that is extremely inefficient. You kind of want to the best you can, limit the amount of income you earn from interest. And that means typically real estate, bonds, guaranteed investments that pay like a fixed rate of interest, even like a high interest savings account. All of that money that you earn, that 1% that you earn in 2020, 2021, is totally taxed. So that's something that's really important to know. Interest, income is taxed at 100%. Now that might seem obvious, right? It's like, yeah, of course, it's like I made this income, of course the government's gonna tax it at 100%, but that's where our second form of taxation comes in, and it's called capital gains taxes, okay? Now this is different, and you'll easily kind of be able to tell the difference, because interest income is income that's earned from your money. It's like there's income coming in on interest or a bond or real estate or something like that. Whereas a capital gain is when you sell something for a larger price than you bought it for, or a higher price than you bought it for. Let's say I buy a piece of property. We'll continue with that example because it's pretty easy. I buy a house for $200,000, and a couple years down the line, I sell it for $250,000. What that means is I sold it for $250 and I bought it for $200. There's a gain there, right? We call that a capital gain. Now, the great thing about capital gains is that they're only half of the gain is taxed, right? So before, if we earn $10,000 in interest income, all of it gets added to our taxable income. That's pretty tough. But when we have a taxable capital gain, we sold something for higher than we bought it, what that means is that we only pay taxes on half of that gain. So let's go back to that example, right? We sell a house for $250 that we bought for $200. There's a $50,000 gain there. But instead of $50,000 getting added to our total tax bill for the year, only $25,000 gets added. So this is the really fascinating thing about taxable capital gains, is that when we buy something and sell it higher, we actually end up with a more tax efficient investment than if we own a piece of real estate that produces income, or some sort of bond portfolio that produces income. But where a lot of young people, I believe, are about to go wrong is something called short-term capital gains. If I have the intention of investing in something for a long period of time and seeing the value of that increase, that's a long-term capital gain. But if I'm one of these little traders who's opening up my brokerage account and placing 10 trades a day and buying this stock here and selling it the next day and buying this stock here and selling it the next day, or buying a house and selling it right away just to flip it and make some extra money, the government is going to quickly realize what you're doing is you're trading. You're not really investing in a way to actually contribute to the economy. You're just kind of arbitraging little opportunities. And what that means is if they see a pattern of that over time, they're going to designate your capital gains as actual short-term trading, short-term capital gains. So in that case, it actually acts as interest income from before. 100% of it gets added to your taxable income. So just as a side tangent, this is the stuff that beefs me up about like this whole short-term trading thing. People want to get involved in like the gambling aspect of the stock market. It's like, not only are you paying commissions of like $8 a trade or $5 a trade, whatever it is, now you're going to pay 100, all of the gains you make are going to be fully taxable. So now you might pay 50% of those gains away in taxes and $6 away in trading fees. It's like, how do you expect to beat the market if you're a retail trader and you're doing this short-term trading thing? I don't buy it. Now, our third form of taxation is a really great thing to understand, but it is by far and away the most complex form of taxation. And the reason this is because in the Western world, and I guess all over the world now, we have these things called corporations. And a corporation goes about its daily activities. It's like, your local corner store, or even the business that I own. A corporation's main job is to provide value to the public and have sales. And then it's also gonna have some expenses, right? And what's left over at the end of the day is profit. Now, the profit of the company doesn't just kind of stay in the company. It can actually get paid out to the owners of the business. And if you and I invest in stocks, that's the whole point of this video. How are we getting taxed when we buy stocks? If the owners of the company elect to take a dividend, let's say there's profit left over at the end of the year, they want to distribute that to the owners, us, when we own a stock, that comes in the form of a dividend. And that's our final and most complicated form of taxation. We have income, pretty easy. 100% of it goes to taxable income. We have capital gains. Pretty simple as well. 50% of the capital gain goes to taxable income. With dividends, it is much more complex because the corporation where the money was generated has already been taxed by the government, and now they're going to pay out profits to us as investors, and they're trying to avoid this whole double taxation thing. They want to make sure that it's at least some degree fair, and that if the corporation has already paid tax and now they're going to pay us as investors, that doesn't get taxed to the corporation and then taxed again to us. So what they have is this thing called the dividend tax credit. Now, as you should know, if you're getting this far in the video, there's a difference between a tax deduction and a tax credit. A tax credit reduces the amount of tax you have owing after doing all of the tax calculations. So all of this being said, what is the dividend tax credit? Well, it definitely varies depending on the country and where you live. But the general rule is that if you live in a country like America or Canada and you're investing in stocks that are headquartered or operate in that country, what is going to happen is you will get something called a dividend tax credit. And what this is meant to do is really help support the local companies in your economy by making it easier and more tax friendly to invest in them. And where I am, what this means is we do something called a dividend gross up. So I'll run us through an example here. Let's say we get a $1,000 dividend. What happens is that gets grossed up where I am in Canada by 38%. So instead of just claiming $1,000 for taxes, I'm actually gonna claim on that dividend $1,380, okay? So I'm actually claiming more, which is kind of weird because we think that this is gonna be some tax advantage when in reality it seems immediately like we're paying more in taxes. But then what happens is we take that grossed up number of $1,380 and we apply a 15% tax credit to that, okay? So what that means is we take that $1,380 amount, multiply it by 0.15 or 15. And what that means is that we get a $207 tax credit back. So if we have a dividend of $1,000, we gross that up to $1,380. And then what happens is if you were, in a marginal tax bracket of 25%, you take $1,380, multiply it by 25%, and you get $345, right? So now you take that $345 and you subtract the $207 in the tax credit, and you end up with about a tax rate that's closer to 13 or 14%. So that's obviously a lot more effective than if this was just all added to taxable income. Now, that all might seem great and complex, but maybe you feel like you've got your head wrapped around it. Well, too bad, because it's completely different depending on what country you live in and what company stock you're owning. So when it comes to investing, guys, if you feel like the tax implications of this are getting beyond what you can handle, you gotta get an accountant, okay? You gotta get a professional to look after this stuff, because the last thing you want is the tax collectors on your back. But at the end of the day, how do we mitigate this stuff, okay? How do we make sure that we're not paying taxes? How do we make sure we end up as the $2.6 million guy or gal versus the $1.4 million guy or gal, because our investments have been eroded by taxes? Well, that's where these government registered plans come in. Things like in Canada, we have an RSP or a TFSA. Things in the United States like an IRA or a Roth. These different accounts, the whole reason they're there is because the government is fairly aware that if they tax all of your investment earnings, no one's ever gonna retire. People aren't saving enough as it is or investing enough as it is. Never mind if they tax all of those investment gains. No one would ever retire if they were that penalizing towards your investments. So they give you these plans, they give you two great tools, and that is how you eliminate this. That's why people recommend, hey, if you're starting out investing for the first time, use a Roth, use a TFSA, use an RRSP to get a tax deduction when you invest, because when you put money into these accounts and they grow over time, there are no taxes levied. When I talked about income, I talked about dividends, I talked about capital gains. none of that applies. None of it applies. It is all completely tax-free if you use one of those accounts. So anyways, guys, I know it's tax time. I know your head's probably spinning with all this stuff, but I hope you got some value out of today's video and how stocks and different types of investments are taxed. Anyways, guys, if you get any value out of these whatsoever, please make sure, like I said before, hit that subscribe button down below, hit that like button, and turn on post notifications for more videos just like this one every single week. Until next time.